back to the North Pole on Christmas, so I don't know why the Santa Claus rallies after Christmas.
There is a similarity to 2017 December into January 2018. There were some headwinds to the market going higher, headwinds to economic growth, that sort of thing. Once we had that trade deal, the tax cut in late December, we just exploded into year end, and then we're up at some point 8% or so in January, followed by a few months sell-off. I think you could be setting up for something very similar, especially if this December 15th trade deadline is just really a push out, or it's just something where they're kind of taking back some of the tariffs that they put on over the last few months. I don't think that's the sort of sustainable thing to get the market going meaningfully higher into 2020 past January.
Mike, to the point of this discussion, do you need to see manufacturing data to improve as well, given just the rally we've had, the multiples we've got? It's not like it's currently pricing in a recession.
I think over the coming weeks, you would definitely want to see traction in the global manufacturing numbers. And you want to see that idea that you had a bottoming in industrial activity in the fourth quarter. Yes, I think that has to come at some point. But I'm kind of with Dan in the sense that, if you get this kind of all clear type trade, you can just get kind of a rush of relief and money flow into the market. Even up 8% from here wouldn't take you to kind of as precarious a spot as we were in January of 2018.
Dryden, what's your take? Do we need to see better data than we've already seen to get decent gains in 2020?
I don't think so. And the reason why is I think we're underestimating the fact you've got 2.2 million more people working this Christmas than you had last Christmas. We basically, when you take a 3% increase in wages, you take the number of people that have come into the labor force, we have almost $500 billion of additional income in the U.S. economy. That's like growing a country bigger than Ireland in 1 year. So when you think about that, at the end of the year here, Christmas is going to be better than it was. If you got a job, Christmas is better than last year. But moving forward into next year, you have this tremendous incentive. It's $500 billion of additional income people have moving forward into next year that really kind of pushes the economy forward. And so we're positive on it. Obviously, there'll be volatility and some headwinds. That'll be political and other things. But the fundamental underlying piece of this economy is more people are working. They're making more money. They're spending it. The U.S. consumer, the wage and job market is strong, and consumers are in control.
I was just going to say, you're setting this up perfectly for me to ask you about some consumer discretionary names going into this holiday season. It sounds like you sound very positive on the state of the U.S. consumer and their position with their wallet going into Christmas time. Any names there that you like?
Well, the names we like are pretty obvious, but we like Amazon here. When you take a look at e-commerce, it was up 19% over Black Friday and the days after that. So Amazon's dominant there. We like Visa and MasterCard. They get a piece out of every transaction, 85% of the market in the U.S., 96% in Europe. We like Disney a lot because they've really kind of gotten their strength into this, not only streaming, but content. And we think Walmart is beginning to really move forward in the e-commerce area, and they're seeing some improvement there. And 25% of the United States buys their groceries at Walmart. So those are the names we like that are consumer-based, moving forward into the end of the year and moving forward as we get into next year as well.